The Financial Sense Midweek Edition with Jim Paplava. Delving in-depth with authors and experts into the key economic issues.
Welcome, everybody, to a special interview that I did with Felix Zulauf. We talked about so many topics that we decided that we had to break it up in two parts because we went overtime. In part two, I will talk about the shortened business cycle. We seem to repeat this pattern since 2010. We begin the year on a good note. The economy begins to slow down. And then we get the monetary bazooka, some form of quantitative easing, and we repeat the cycle over again. It seems like we're going to be in this type of a cycle for the balance of this decade. And, of course, what all this means for the gold market. And that is the topic of today's discussion. You know, Felix, one pattern that I have noticed that we've seen, and you just talked about it repeating itself, in 2010, we had rising leading economic indicators coming off the stimulus. By the time we got to late spring, the market softened. And in fact, in June of 2010, Ben Bernanke was writing op-ed pieces in the Wall Street Journal talking about their exit plan. Well, we had a continuation of falling LEIs. The economy softened. And then in August in Jackson Hole, he alerted the world to quantitative easing. At the end of the year, the Fed launched QE2. Congress launched a payroll reduction tax, so we began 2011 on an up note. The LEIs were rising. They began to soften again, leading into October, and then we had another rise towards the end of the year. This seems to be a pattern that is being repeated. We get stimulus. It generates more economic activity. When the stimulus wears off, the economic activity begins to decline again. We get deflationary forces, and then they come back with another round of stimulus. Is that really what you're telling us here, that perhaps it's rising now, but as these inventory levels build up again, as the stimulus wears off, will be softening again, and then that's something the markets will have to reckon with?
That's pretty much what I believe is happening. We do not have, due to the structural problems we talked about before, we do not have full and extensive business cycle expansions, but what we do have is those mini cycle or mini swings in a compressed range at a relatively low level. And whenever it turns up, and particularly when it's accompanied by some monetary stimulus from one side or the other, markets that are oversold then rally, believing that this is the turn for the better. And we have seen that several times, and I think we will see it another few times before the markets eventually exhaust themselves and the optimism wanes again and they become more realistic in the assessment. So my hunch was that we would have a friendly market in the first quarter coming out of the oversold situation in fall of last year. January has been stronger than I expected, quite frankly, and some of the market indicators that I watch probably suggest have improved structurally and probably suggest that the whole move can last longer. Maybe my scenario has to be postponed or pushed out a little bit in time. I would still expect some sort of a topping in late first quarter, early second quarter, and then a correction. And then the nature of that correction will tell a lot about what's to come. If that correction into, let's say, late summer would be shallow, then I would think that we would have another shot to higher highs even later in the year. If that correction turns out into a more severe decline, then I think that was it, and that was probably the peak of the mini cycle that started in 2009, in March 2009. I do not know. I think you have to be very tactical at the next intermediate term top, which I expect late this quarter.
In your Barron's Roundtable interview, you recommended 3 investments: 10-year treasuries, Aussie 3-year bond futures, and gold. Felix, that's a portfolio that is set up for a pretty bearish scenario, I would think.
Yeah, I would exclude Australia a little bit as a tremendous bearish scenario because Australia has seen a business expansion now for 20 years. The last recession in Australia was in 91. It's a pretty overheated economy. Housing prices have gone up more than they did in the U.S. or in Ireland or in Spain. It is a completely overheated housing market, and it's all the result of the big investment and commodity boom coming out of China's rise. If I'm right about China and the ratcheting down and the cyclical slowdown going further in China, then it should affect Australia. And eventually I would expect that the Australian Central Bank, Reserve Bank of Australia, will cut interest rates to help the economy. And I selected a short-term bond future, a 3-year bond future that really swings with short-term interest rates. The Treasury in the U.S. is a little bit a different story. I think we are in the end game of the 30-year decline in long-term interest rates, not just in the U.S., but in the developed world. Actually, when you look back as far as you can in historical charts, be it the U.S. or U.K. or whatever, you see a pretty clear rhythm of interest rates rising for 30 years, declining for 30 years, etc. And we peaked in 81, and we are now at record lows, lower than in the Depression years, and manipulated also by central banks to these levels. So we are at the very end, and I would certainly not recommend long-term treasuries as a long-term investment. I think I remarked when I talked about it that this was a trade because I expect, particularly the middle part of the year or the second half of the year, I expect some disappointing developments in the real economy and in the markets. And therefore, we could have, out of this current trading range, we could have another shot in yields to the downside to complete the 30-year decline. What's been interesting in the recent stock market rally is that bonds have gone sideways. Usually when you have risk assets rallying or risk-on rallies, so to speak, government bonds usually declined, and this time they held up pretty well. I wouldn't buy them right now. I think there is some more choppiness and vulnerability very, very short term as a trader. But I think, and that's what I said also, when 10-year governments in the U.S. shoot up into the range of 220 or so, for a trader, that's an opportunity for a trade out of the range to the downside. And where that will stop, at 150 or 125, I don't know. And it's a risky thing. You have to be a tactician. You have to operate very disciplined. This is not a long-term investment proposal. As a long-term investment proposal, I would recommend to sell your long-term bonds very soon.
One of the other recommendations that you made is you recommended owning gold. Gold is up, Felix, 12% this year. Its 12th consecutive year of gains. Why do you believe so many in the financial business that you and I are a part of have had a hard time understanding it? Every time it hits a new high, it's called a bubble. When it corrects, they declare the bull market is over. Let's talk about gold.
Well, gold is actually the only true bull market where we have gone from high to new highs to new highs to new highs over a long period of time every year, as the bond market has been for 30 years, but the bond markets are manipulated due to central bank intervention. Actually, it's the biggest financial market manipulation of all times that we are witnessing in our bond markets. gold is different. The central banks are not buying gold. Gold is a reflection of what we talked about earlier in our conversation, namely that there is no other escape out of this problematic situation we are trapped in than printing money and financing the banks and the governments via central bank money printing to keep the system alive and preventing a systemic collapse. As that is done, you have monetary inflation. You create more and more paper money. Whether the paper money does anything in the real economy, leads to final demand, is a completely different question. I do not believe it does to a large extent. But you create more paper currencies. And therefore, in paper currencies expressed, the price of gold goes up because you cannot create as much gold every year as you can create paper currencies. So from a demand-supply side, it's very clear that gold should go further up as long as central banks print money at the speed they do. And as I said earlier, I do believe that the balance sheets of central banks will eventually, in coming years, go to the level of our GDPs. And that means that the price of gold expressed in those currencies will have a long way to go on the upside. This year may be a little bit tricky. If my scenario is right, that we have some disappointments which could revive deflationary fears once more, then it would mean that gold has a longer consolidation to go through. You know, we peaked at over 1900 last summer, fell down $400, are now in a rally, which could be just an interlude within a congestion, a longer-term congestion period. But as a long-term investor, you have to own gold, and any declines, and I think the next opportunity to buy will be around summertime, whatever the level is, because there is no way out than printing money, and therefore gold represents only a little bit less than 1% of all the capitalization of equities and bonds and money markets in the world. More and more investors and wealthy people realize that something is wrong with our system and that they are getting cheated by our central banks. And if they want to switch just a tiny fraction of their capital, of their savings into gold, or less than 1% could go to 2% or 3%. In 1968, it was at 5%. In 1980, at the last peak of gold, it was at 3%. Think about what it would do to the price of gold if all of a sudden the gold holdings by the people want to push it up to 3% of the market capitalization of global equities, bonds, and money markets. That would mean that the price has to go up dramatically, at least 3 times.
When I think of the gold market, Felix, I think of 2 kinds of markets. I think of the paper market for gold, represented in derivatives, the futures market, and the physical market for gold. And sometimes the 2 act differently. What I mean by that, we see that in 2011, there was a record demand for physical gold. But the leverage, which we see in the derivative paper market, can sometimes cause gold to correct, especially if you're leveraged and the players, let's say they start incurring losses, they're oftentimes forced to sell and liquidate things. Seems like when that happens, when there's a deleveraging in the futures market for whatever reasons, it's almost an ideal time to accumulate physical when the prices corrects. In other words, when we had gold at 1900, everybody wanted to own it. When it dropped down to 1500, nobody liked it because they thought it was in a bear market. But it seems like there's two markets for gold, paper and physical.
Yes, and what I said about the central banks in the developed world is also true of the central banks in the emerging world. I mean, the Chinese have expanded their balance sheet of the central bank more than the Americans or the Europeans. So they have been the worst. And the Chinese who got some savings, and they are big savers, also big spenders, but they have a high savings rate. They also buy a lot of gold, and they are important and to a rising importance gold buyers, the same with the Indians, etc., etc. You have to look at these two markets, as you correctly say, in a way like you look at the guy who walks his dog. The guy who walks in one direction, that's the fundamental physical gold market. And the dog runs sometimes ahead and sometimes stays behind. And that's the leverage market. So that swings much more than the master of the dog who just walks in that direction. And we are probably still in a correction from that top that could go on another couple of months. This is an interim rally, and we probably come down once more. But the important thing is not the short-term timing of gold. The important thing is that you have to have an investment position, and if you are not sure, and if you don't have it yet or not enough, and you're not sure as an investor, you rather should do your step-by-step accumulation over time, because that's where you make sure you end up with a good investment over the years. And I think this year is a time where the gold fever will probably be a little bit lower than in recent years, and I see that as a positive. This is the time to accumulate quietly, step by step, because the price eventually will go much higher.
Now, I have noticed in just reading your interviews, either in your blog or in Barron's, you prefer physical over paper gold, although sometimes you will hedge that position. Felix, is that mainly due to counterparty risk, as we saw, for example, in MF Global? Why do you prefer physical over paper?
Well, physical means that I can anytime go to my safe, wherever I have it, and get the bars out. And if I need to, I can sell it in the market. If I have it in paper and something very bad happens, let's say something goes wrong in our system, and all of a sudden they change the rules or whatever, you have you own paper gold, you can probably not sell it, you cannot touch it, maybe it's not even there. That could also be, and therefore I'm a conservative Swiss who likes to own it in physical terms. What I do from time to time, when I think there is a bigger correction coming, I try to trade on the short side against my physical holdings, just to sleep a little bit better.
If I was to summarize, Felix, as I read your interview in Barron's, you see a pretty good first quarter that maybe, if we get lucky, could extend into the second quarter for a period of time, but the structural impediments to these economies will eventually begin to surface again. So we could see another downturn in the market, a slowdown in the economy, that would probably, depending on the extent of the decline in the markets, would once again be followed by some kind of monetary easing or money printing, and then we would be up and away again. Is there anything in terms of how you see things playing out that would cause you to change that point of view? And if there is, what would it be?
I think you summarized my current expectations very well. That's exactly how I see it. What we do not know is whether on the next downturn something breaks, some important rules are being changed, etc., because we are moving more and more into an economy and a society in the developed world that is less free, more government controlled, and therefore the authorities can change and will change whatever is to their benefit as rules to the detriment of investors and citizens anytime. So we do not know how the world looks like. I don't like the trends we are on, and therefore I always am prepared for the worst and I hope for the best.
Well, Felix, I want to thank you for joining us here on the Financial Sense News Hour. You've been very generous with your time. And for our listeners, if you'd like to follow Felix's work, he has a blog. It's Felix Zulauf, and that's spelled Z-U-L-A-U-F. FelixZulaufblog.blogspot.com, and you can find out more about what Felix is thinking. Felix, I want to thank you for joining us on the program. All the best to you, sir. Have a healthy new year.
Thank you, Jim, for having me, and all the best to you, too. Thank you. Bye-bye.
You can subscribe to Financial Sense News Hour in the iTunes and BlackBerry podcast libraries or at feeds.feedburner.com/FSN. Find more information about our guests at www.financialsense.com/newshour. Friend us at www.facebook.com/financialsenseonline. For our on-the-go listeners, you can access Financial Sense on your mobile device at m.financialsense.com. The Financial Sense News Hour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the News Hour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of James Poplava and do not take into account listeners' suitability, objectives, or risk tolerance. Financial Sense News Hour and its parent company shall not be liable for any financial losses that result from investing in any companies profiled on or advertising with Financial Sense, or arising out of the use of any material on the News Hour. Be advised that you invest at your own risk.